Okay, everybody, welcome to today's video lesson. Today's lesson is on the core tenets of technical analysis. So first, let's begin by what is technical analysis. Technical analysis is a method of evaluating securities by relying on the assumption that market data, such as price, volume, and certain indicators can help predict future market trends. Now that's the definition by investor words. Number two, charts are a reflection of the trend of the stock. The trend is the price action represented in the candlesticks. Okay, so technical analysis is a reflection of the trend of the stock. So when you pull up a stock chart and you visually see the representation of that chart, it's a reflection of the price action in the candlesticks. Okay, now in order to be a successful stock market technician, you must first look at the charts of the stock that you are trading and then make your trading decisions based on what's occurring on the chart. Okay, so number three, technical analysis is considered an art form similar to that of playing the piano, and many traders will interpret the charts differently. One thing I want to mention is technical analysis is a visual skill. So one trader might see things one way, another trader might see things another way, and there's no right or wrong answer. Every trader sees the chart based on their own representation. Okay, now I put it's considered an art form similar to that of the piano. But playing the piano is definitely an art form. It takes many, many years to master that skill, but it is an art form. Well, technical analysis is no different. It is an art form, similar to playing the piano. It takes years and years and years to master this skill. Okay? So, number four, this skill, like any other skill, takes hard work and dedication to master. Trading and technical analysis is no different. It takes hard work, it takes dedication to master. Okay? You must spend days and days and hours looking at charts if you are going to master technical analysis. Okay, so let's look at a visual. Take a look at this stock chart here. This is a representation of the SPY S&P 500. It is the 500 largest companies in the world. So these are called Japanese candlesticks, and this represents the buying and the selling of the S&P 500, and it's represented in the chart. Okay, like we said a minute ago, it's a visual skill, but technical analysis allows us to see what is occurring on the chart. Okay, so this is a visual representation of a chart. That's technical analysis. Okay, so the core tenets of technical analysis. Number one, history repeats itself. Number two, market action discounts everything. And number three, prices move in trends. And so the core tenets of technical analysis, this is critical for determining your assumptions based on the market. Okay? Technical analysis is the language of the market. Number one, history repeats itself. The stock market is governed by two principles, fear and greed, and supply and demand. Both of these principles are based on human nature, and human nature doesn't change. So history repeats itself because people either are fearful, or they're greedy, or they buy, or they sell. Supply and demand. Number two, pattern and price formations are not created randomly. Institutions, or I call them the big money. This is people that have a lot more money than me and you. These are mutual fund companies. These are insurance companies, large banks. Institutions create the charts. And history does repeat itself because these institutions, they follow a clear set of rules and they're always looking toward the future. Okay, so pattern and price formations are not created randomly because institutions have clear buying patterns. It is based on past and future movements. Number 3, any negative surprise or uncertainty of an event can cause the big money to alter their decisions, which will affect the future trend of the stock. Now, history repeats itself because, again, like I said, institutions follow rules. Okay, they trade their rules over and over again the same way. But there are times when negative surprises can creep into the market. This can be political events, wars, natural disasters. Institutions don't like negative surprises. So when a negative surprise or uncertainty of an event, this can cause those institutions to alter their decisions. Maybe they're buying and they're buying and they're buying, but then a uncertain news event pops in and then their decisions change. Or maybe they're buying a company based on the value that they believe, but then that company does something illegal, because again, we can't see the future. It does something illegal, it's a negative surprise, and then institutions will step in and that causes them to sell, and that will alter the trend of the stock. So history repeats itself. Okay, the stock market is governed by 2 principles, fear and greed, supply and demand. Pattern and price formations are not created randomly because institutions follow a clear set of rules, and any negative surprise can alter the trend, such as a news event, political event, or natural disaster. Number 2, market action discounts everything. Everything that is known in the world at the time is factored into the current price of the stock. Okay? So let me repeat. Everything that is known in the world at the time is factored into the current price of the stock. Again, we do not know the future. Institutions don't know the future. So when they buy a stock, they are going by what their assumptions are at that time, based on everything at that time that is known in the world. Okay? So market action discounts everything. When companies are buying, they're buying. You can see that in the representations of the charts, and that has everything factored into it. Everything that is known in the world is factored into the chart and is baked into the price. Okay. Number 2, all information, past, current, and future, is discounted into the markets, and this information is reflected in the stock. Again, all the information, past information, current information, and future information is discounted into the market. Okay, this is reflected in the price of the stock. Again, everything is known. Everything in the world at the time is already baked into the price action. That is why charts go up or charts go down. And number 3, the shifts of supply and demand are represented in the price action. Okay? The shifts in supplies and demand are represented in the price action of the stock that we are trading. And by utilizing our skills of technical analysis, we can see these shifts as they occur. So when we look at a chart, if the chart's going up, that's all we need to know. As soon as the chart shifts and starts to go down, that means institutions are now selling. That's all we need to know. But it's represented in the price. So market action discounts everything. Just watch the chart, make your assumptions based on logic and what is happening on the charts. Number 3, prices move in trends. If you're going to master the skill of technical analysis, then it is critical that you understand trend. Trends, number 1, trends are a representation of what buyers and sellers are doing. Trend is the direction of trading. If the trend is going up, institutions are buying. If the trends are going down, institutions are selling. If we have up days in the market, that means that there are more buyers that day than sellers. If we have a down day in the market, that means there are more sellers than buyers. Now, there's different time frames when it comes to trend. One is our short-term trend. Okay, everybody might have a different definition for short-term trend, but my definition based in the book is 2 days to 4 weeks. Intermediate term trend, my definition is 4 weeks to 9 months. And then long-term trend, my definition is 9 months on. Okay, so that is the definitions, and it's critical to know the time frame of the trend you are trading. For example, I talk about bull flag, and I have a course on the bull flag trading plan. That is a short-term trade. So if I'm trading the bull flag trade, I need to make sure that it matches my short-term assumptions of the direction I believe the market is going to go. Number 3, big money institutions control most of the world's wealth, and it is the institutions that create the trend. Like we mentioned a minute ago, it's not your money, it's not my money that's moving these trends. It is the institutions or big money. They are the ones that create the trends based on their buying and or their selling. Number 4, what matters the most is the direction of the trend. The trend is the most profitable outcome. Okay? We, as technical traders, we need to assume that the trend is going to continue until it proves us wrong by either stopping us out or we forecasted the right direction and it hit our target. So what matters is the direction of trend. Now, if you're interested in my Options Elite Masterclass or any of the indicators or software that I use to trade the options market every day, make sure you check down below in the description for all the bonuses I'm offering this month. And if you want to get better at trading the TTM squeeze indicator, click right.